Hi, everyone, and welcome to the Amber Data Derivatives podcast. I'm here with Pierino Ursone. He is the head of options at Deribit with a background in market making in the 90s as well as proprietary trading in the 2000s and the author of How to Calculate Option Prices in Their Greeks. Pierino, how are you?
Yeah, hi Greg. Thank you very much. Yeah, good to be here and nice to have a chat about DVOL. Looking forward to it.
Absolutely. So I'm really excited about DVOL. Before sort of jumping into that, which is the new futures that you guys are launching at Deribit, can we just learn a little bit about your background and sort of an overview of your career?
Yeah, sure. I started some time ago at an obscure small firm called Optiver. That was 30 years ago at the Amsterdam Exchange. I started as a market maker. I have been trading on the floor for about 10 years, up to mid 2001. Then I went into the energy commodity business. Very exciting business, especially those years when Enron was still there. And after the energy business, I wrote my book. It made me quite proud having it published with Wiley. And then afterwards, I came back into the equity options trading again, trading the Western European indices and single stock options. And then I got introduced at Deribit, and I had something like, this is really cool. This is interesting. It's a high volatile environment. I like the people. They're offering me a very creative job. It's diversified. It's like educating people. It's client contact. Obviously, it's also designing new products. It's working on the risk side. So for me, it was a great opportunity to enter the crypto business. And yeah, it's a high volatile environment, and I'm absolutely enjoying it.
Yeah, that's fantastic. So going back to your career, since you were market making in the 90s, one of the things that's really interesting is in crypto, the volatility surface is still sort of being figured out. When you were market making back in the 90s, was there any sort of similarities? Was the volatility pricing as efficient back then as it is today?
Oh, no. It wasn't. It's actually the word skew didn't exist. I was trading at the Amsterdam Options Exchange, and we were trading flat volatility in the options. In the US, skew, or let's say to put additional premium in out of the money puts, because everybody had learned their lesson after the 1987 crash. That was an implementation in the US which we hadn't done yet. So actually, we were just trading there. We had some feeling about volatility, but not about smiles, etc. So a lot of US traders also came to Amsterdam, and they told us the hard way that you should apply skew, you should pay up for your out-of-money puts. But it was a whole different environment. We were in a crowd. I was in a crowd with 30 to 40 competitors, all striving for the best contracts. So this exchange was actually set up to have price competition as well. Because if you would be slow or if your pricing would be off, you won't earn a buck. So I already traded some automated markets in the beginning of the 90s. In 93, I traded the DAX, the German index options. That was already automated, but in a slow way. But it's uncomparable but with what is happening nowadays. People are sitting at the office. It's quiet. People are concentrated. While I came from an environment where when the shit hits the fan, 700 people were shouting and crying. And I still remember one day that there was panic in the market. And I thought, okay, I'm going to do one step backwards and enjoy this, because it was a great environment, but it was not super professional. We thought we were professionals, but we weren't. There were no sophisticated option models. We all used the Black and Scholes model, and actually everybody had a piece of paper with the prices on it, and then watching the paper, watching the screens, and then quoting the market. But the fun thing was, when the market would go in one direction, it would run off your paper. So everybody then has to leave the pit to print out more papers at actually the time when it's the busiest time of the year. So that also, because of that, I tried to learn options from the top of my head, to come up with rules of thumb, and to be able to price options without using these papers, because that will really bring you an advantage. But now we have our systems calculating the options, and if you're a sophisticated company, the systems are making your bids and offers. They will adjust, they will change. So yeah, it's uncomparable. It's great to see. It was a great time, but in the end, everything is so sophisticated at the moment. I'm really amazed by that.
Yeah, that's really interesting. So you had this static sheet with your theoretical values and your vols, and when the market moves fast, you need to go out and update everything manually to start quoting again. That's so interesting.
Yeah.
So
yeah, I agree. It's insane.
that is funny. So in '93, we had CBOE launched a VIX index. In 2004, I think they launched the VIX Futures. When the VIX index first launched, was that well received, or did people think this was a new concept, or had they already been thinking about things like this?
Yeah, but for option market makers, it was not that important. The main importance was actually pricing your options in the right way. And you had your two-way markets, and maybe you could end up the day with a flat optionality book or a flat Greeks book. So it was not that important. And finally, when the VIX became much more as a extremely important instrument in the traditional financial business, I was already in the energy commodity trading business. So I did look at oil volatility, like the WTI longer term, mid volatility. Where are we now? It's now there's an index that's called the OVX, the oil volatility index. But yeah, so I was not that much used to working with the VIX index. But in the end, when I came back in the equity markets in 2017, then immediately I was faced with a VIX which was trading at the all-time low. It was even trading below 10%. And I can only think of 2017 when that happened. Maybe I think also some longer time, but okay, it was exceptionally low. I was also trading Dutch index options, IEX options, and I can still remember trading short-term options at around 7.5% of volatility, which is it's super low. But yeah. So at that stage, I got more and more into looking at the VIX and later also on the V stocks. In the past years, I have been trading Euro stocks options. So then you will have to look at, let's say, V stocks and VIX, or the combination of the two. Yeah.
Oh, that's interesting. So one of the things in crypto that's fascinating is that it's a 365-day, 24 hours a day market. So Deribit's always open versus traditional finance where we have 252 trading days. How does that affect volatility or option pricing and stuff like that?
It affects it massively, because If you think of Deribit, we're open 8,760 hours a year. Sorry. While the traditional markets not even getting, let's say, at 45% of that total amount of hours. So meaning that in the times that when the traditional market is not trading, still things can happen. And just think about January. What happened in the beginning of January? The market was very quiet, but then suddenly on a Friday evening late, when the traditional market was closed, Bitcoin and ETH exploded, and the next week they exploded again. In the past the 2 weeks, we've seen the USDC issues. That started on Friday evening, and actually that was solved on Monday. But it already created a lot of volatility in the market, especially in the USDC products versus the USD products. So yeah, it's a definitive advantage having optionality all day around. But yes, of course, therefore, having optionality will be also a bit more expensive.
Yeah, that's really fascinating. I imagine there's probably some opportunity there between sort of CME products versus Deribit products and how those are priced because of that. That's an interesting insight.
Yeah.
So jumping onto the DVOL, so this is something Deribit launched its DVOL index a few years back, but the DVOL future on the index, this is just being launched right now. It's very exciting. Can you please just give us an overview of DVOL and what it is for anyone who's sort of new to this type of concept?
Yeah. What we do is we measure the volatility of the market. So we look 30 days further, and then let's say we take two expiries, which are the closest to 30 days in advance, and then we'll measure the options, but not only the at-the-money options, but also the out-of-the-money options. So we will measure out-of-the-money calls and out-of-the-money puts and at-the-money options. So that means that the DVOL index will be a little bit higher than at money, because in the crypto markets, we know what we call this shape, the smile, or what we call in the professional business, we call it skew. But that skew, that smile, that can be steeper, it can be shallower. At the same time, volatility can move up and down. So it's like a breathing mechanism. But we try to implement all the strikes to give a fair estimation or a fair number of what traders think that will happen with the volatility in the coming 30 days.
Yeah, that makes a lot of sense. So it's got a much more sort of holistic view by calculating a bunch of strikes instead of just at the money. And so you can get a really good feel for a basket of 30-day options, so to speak. So with the DVOL index, you guys have cutoffs at the wings. Can you explain that and why that's important?
Yeah, sure. The cutoffs is actually done because of the fact that we don't want to see manipulation in the market. We would like to show a fair market, and if you talk about far out of the money options, then a small change, especially in out of the money puts, can already have an impact in the absolute number of the DVOL. So let's say if there's a worthless out of the money put option, but somebody's able to make some bits in it, make it more expensive, then that will automatically raise the DVOL level. So what we have been doing is creating a model where we would say, okay, let's try to manipulate the market. How can we prevent that? So we had two options. One option was to have a fixed price and saying any option below that specific price will not be taken into account, or we do it via delta. In the end, we figured out that if you have a fixed amount or a fixed price where you have a cutoff, then that's extremely static. When volatility is very low, it means that there will be a small range only measured, because all the other out of money options might already be less worth than that cutoff level. So therefore, we have decided for the delta 5% cutoff level. And we think that also therefore it will be a lot more difficult to try to move that DVOL index.
Yeah, that makes a lot of sense. So without this type of cutoff, theoretically someone could have, just for an example, $1 billion DVOL future position, and then they go in the options market and they buy a bunch of one delta options, and it moves up the overall vol, which moves up the index, and then the futures settle to that. So that's really interesting.
Yeah.
So we can get rid of that.
Yeah.
With
Yeah, absolutely. And we were quite focused on that one. We really considered that as an important feature for the launch of these futures. Yeah.
Yeah, that makes a ton of sense. And this is why, really Deribit's the only one who can launch an index like this, because you have enough liquidity in the options to have this type of index that won't be manipulated. Can you maybe just talk about the settlement process? How do DVOL futures settle to the DVOL index?
Yeah, we every day at 8 UTC we have one snapshot of the market, and that will decide where we settle for that day. But at expiration, we have a 1 hour settlement period between 7 and 8 UTC in the morning. And we make every 4 seconds, we make a snapshot of the market and measure the index. So in total, we will have 900 measure points to determine the final settlement of that contract.
Yeah, cool. And then can you just maybe explain from, market makers' perspective? So market makers are going to be providing quotes on the DVOL. Is there sort of an incentive for market makers? Also, is it similar for them to, what's the difference between market making on options versus market making on DVOL futures? Can you touch on that?
Or market making on futures. It can be both. I think you can be a market maker and only trade the futures in this product. But on the other hand, I think it's quite important that you know which options are in there, and that you will be able to replicate the number somehow, that you're not caught by surprise. Because I can understand if this is a successful product and we have a good churning rate, meaning that a lot of bids and offers are coming in and a lot of trades in all directions are going through. It is interesting, although I would advise people market making it having the knowledge of options, just to make sure. And for market makers in options itself, it has a great advantage. Let's say you're a market maker and you do one big trade. And that big trade gives you not only exposure in the market going up or down, but also exposure in the Greeks, exposure in volatility. So as a market maker, you're trying to neutralize your position as much as possible. So against buying a bunch of options, you need to sell something in the market as well, and preferably in the same maturity. So then if nothing happens, if there's no liquidity in the market at that specific moment, then you can also decide in trading the DVOL futures as a quick hedge. If there is a company which has an issue, a risk management department can say, hey guys, listen, your exposure in volatility is too much. We need to reduce your exposure, so you can use volatility futures for that. If we right now we start with only one volatility future, but in the future, we will have, like, let's say 5 futures in BTC, 5 futures in ETH. So you can also play with volatility differentials in the market. What we've seen, for instance, at that period in January when volatility was low, then the DVOL was trading at 40, But the longer term options were still trading around the 60 level.
Mm-hmm.
So you can say, okay, I buy a little bit of short term, I sell a little bit of longer term, so people can spread it. And they can spread the shape of the market, and that's called the contango or backwardation of the market. And that's also a very well known, let's say, trading mechanism in the VIX futures. So that is for the market makers. But then obviously we also have to look at what are the opportunities for the people who have a view on volatility in the market overall. So if somebody might say, I think volatility is way too low. I think that the long-term mean volatility should be somewhere around 60 to 70%, but the market is now trading at 40%, so nothing is happening. So you have two options. One is you can buy optionality via the options, and two is you can buy volatility futures. Okay, let's say you choose for option one, you buy options. Let's say the market is at 20,000 and you buy some at the money calls, and you will hedge your delta, or you buy an at the money straddle, and the market then goes from 20,000 to 28,000. Okay. Then at 28,000, you hardly have any exposure in volatility anymore, since the market ran away from the level where you entered it. So where in first instance you created, let's say, a high volatility exposure by being long at money options, but when the market is at 28,000, then the 20,000 options, they have hardly optionality anymore. So if you do it via options, you won't be in the game anymore if the market runs away from your strikes. So DVOL is an instrument, DVOL futures is an instrument that with which you're always in the game. And that's one of the main important features. But we have another one, and that is, let's say, Bitcoin is at 20,000, volatility is, let's say, is at 60. And you think volatility will go up. And the market goes in one day to 22,000, next day to 18,000, to 23,000, 20,000. So you see that the market is becoming more and more volatile, and you see that the volatility is actually going up. But in the end, let's say you run this position for a month, and you come towards expiry, and in the meantime, you haven't performed any Greek hedging in the market, not with your deltas. With optionality, you have they call a gamma position. That's the change of the delta, but you haven't done anything. But in the end, you see, vol went from 60% to 80%. So I must have made one. But no, that person has actually lost a little bit of money because options, they know they have time decay. Every day an option will get less and less worth. So in this example, the time decay has been bigger than the profit in your view on volatility. So these are very good reasons that if you have a view on volatility, I think you shouldn't touch the options that much because you have all these Greeks. If you have DVOL futures, you won't have to do with any of the Greeks, and that will make life much easier.
That's fascinating. So it's a pure volatility play where you don't have to worry about path dependency or sort of rebalancing your Greek exposure for the other Greeks.
Exactly. And the people who are able to manage these kind of positions with other Greeks, that are the sophisticated market makers. And it will be a challenge for them as well. But in the meantime, you might see some spreads in the market. So I really think it's an interesting feature. It's a nice instrument to have in the crypto business. For several reasons we already discussed here.
And then one of the things I'm really excited about, so you guys are starting with the Bitcoin DVOL futures, and then later on we will launch the Ethereum DVOL futures. And now, because these are linear futures, correct me if I'm wrong, but theoretically at some point people could start selling DVOL ETH versus Bitcoin ETH versus Bitcoin DVOL, and then finally do relative trades in a capital efficient manner.
Yes, and the DVOL BTC or ETH BTC DVOL contracts, they already converged, and so you can play with that as well. Okay, let's put it from this way. We had some questions about margining, because if you're gonna trade a Bitcoin Ethereum contract and then you're gonna trade DVOL, but we're working on that. So actually, Deribit is working in putting everything together and to come out with one risk number instead of having separate risk thingies here for that position and for that position, because we think they belong together and they should be treated in the same way.
That's fantastic. Well, Pierino, thank you so much. I mean, we're really excited to launch this product, the DVOL Futures. It's going to be kind of a revolutionary product, I think, in the crypto vol space. It's something that I've personally been waiting for a long time to look at. And so we'll make sure to support the data as soon as possible. But thank you so much for coming on. I think this was a very educational podcast. I think listeners learned a lot, and I learned a lot as well.
Okay, thank you very much, Greg.
Thank you. We'll see you next time.
Bye-bye. Ciao.